Dear traders, gold is teetering on the edge. Bears are in full control below $4,540, and a liquidity grab under $4,400 could spark a violent cascade toward $4,338. The market has fully priced out June rate cuts, yet real yields are still grinding lower. That dangerous divergence is exactly where the trap sits. Right now, gold is doing something that makes absolutely zero sense to the crowd, and that is precisely why it is about to become the single most predictable trade of the week. Real yields are dipping, the dollar is not ripping higher, and yet gold is getting rejected violently from the same ceiling we have watched for 3 sessions. That is a trap. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end because I am giving you 3 exact levels you can trade tomorrow, complete with stops and targets, and the one number that blows the entire bearish structure apart. Session bias is clear. We are fading every rally until proven otherwise. Gold is in a strong sell on the daily, a strong sell on the 4-hour, and a strong sell on the 1-hour. That multi-time frame alignment does not happen by accident. It means the path of least resistance is lower. The single invalidation level that flips all of this back to neutral, and then potentially bullish, is a daily close above $4,540. Write this number down right now. If we close the comments right now so it's seared into your trading plan. Here is the micro insight that matters. The herd is still trying to buy the dip. We can see it in retail sentiment surveys and in the comment sections of every major gold analysis. Everyone is calling for a bounce off the 200-day moving average. When too many people are staring at the exact same level, that level either becomes a self-fulfilling spring, or it gets run over to take out their stops. With momentum this negative, the probability skews toward the stop run. Let's walk this chart from the top down, because what the weekly is telling us versus the daily is where the real tension lives. On the weekly time frame, we are officially in a sell signal, but zoom out just one step further to the monthly, and the picture flips to a strong buy. That tells you we are inside a correction within a secular bull trend, and those corrections are where fortunes are made or blown. The 200-week moving average is way down near $2,800, so it is not directly relevant for the next 48 hours, but the 200-day moving average on the daily chart is sitting at $4,384, and that is the magnetic level I believe the market wants to test. On the daily chart, price is trapped below every significant moving average that matters right now. The MA5 is at $4,504, the MA10 at $4,524, the MA20 at $4,559, and the MA50 way up at $4,600. MA20 is about to cross below the MA50 if this keeps going for another few days, and that would give us the first daily death cross in months. The daily MACD is printing -39.820, deep in negative territory, and the histogram is still widening to the downside. There is no bullish divergence yet. This momentum is genuine and accelerating. Now come down to the 4-hour chart, and this is where most traders are getting fooled. Here's what most traders miss. At first glance, you might look at the RSI sitting at 42 and think we are approaching oversold conditions. But in a strong trending market, RSI can stay in the 30s for days. What really matters is the hidden divergence forming right now. On the 4-hour, price has made a lower low, but the MACD histogram has made a shallower low. That is a sign that selling momentum is slowing, but let me be absolutely clear, that is not a buy signal. It is a trap for premature longs, because hidden divergence in a downtrend often resolves with one final flush lower as the last weak hands get shaken out before any meaningful bounce. The bull-bear indicator is at -54.996, confirming the raw selling pressure. Let's put exact numbers on the board. Key resistance sits at $4,538. That is the level that has capped every single rally for the past 3 days. Our core news today literally says gold stuck below $4,540 as bears dominate. Support side, immediate support is $4,438, but the level that really matters is $4,393. That is the high volume node from the previous consolidation range. Below that, $4,339 is the measured move target from the bear flag that has been building on the hourly chart. That bear flagpole started from the $4,540 rejection and measures almost exactly $200. So a breakdown below $4,440 opens the door to $4,340. And the ultimate floor. The 200-day MA at $4,384, which sits right between $4,393 and $4,339. I believe that zone from $4,393 down to $4,384 is where institutional limit orders are stacked. That is where the fear architect does its deepest work, right at the level where maximum pain forces capitulation. Gold as a fear asset doesn't just react to geopolitical headlines, it reacts to real yields. Right now, the US 10-year real yield is quietly grinding lower, and yet gold is falling. That inversion is a flashing neon sign that positioning is offside and that a violent mean reversion is coming, but timing it requires precision. Here is the cross-asset linkage you cannot ignore. Gold is moving tick for tick with the breakdown in inflation expectations, but it is also deeply correlated with the Japanese yen right now. The yen is weakening, dollar yen is pushing higher, and that strength in the dollar against the yen is spilling over. Leading indicator. The next signal changes everything. If we break and hold below $4,438 on a 4-hour closing basis, the bear flag activates and the downside accelerates. That is the level that separates winners from losers this week. The last 24 hours of news flow have been unrelentingly bearish for gold. The headline says it all. Gold stuck below $4,540 as bears dominate. Dovish Fed comments earlier this week were completely shrugged off, and hawkish repricing of the rate path is back in control. The market has now fully priced out any rate cut for June, and even July is dangling by a thread. That is the nominal yield story. But beneath the surface, real yields, which strip out inflation expectations, are actually falling. That should be jet fuel for gold, and instead gold is dropping. Why? Because the US dollar liquidity tide is ebbing. The DXY is consolidating in a tight wedge, and every time it even hints at breaking higher, gold gets slammed. We are also seeing a massive unwind of the gold-Bitcoin correlation. Bitcoin is holding above its 200-day MA while gold is sinking toward its own. That decoupling tells me this is not a broad risk-off move. This is a gold-specific positioning flush. On the institutional side, ETF flows have been net negative for the last 3 sessions. Large speculators are trimming longs. There is a strategic value argument emerging. Our analyst sentiment reads, gold under $4,400 still offers strategic value against weak fiat. I do not disagree. But strategic value is a long-term concept. In the next 1 to 2 weeks, the directional lean remains lower until we see a convincing daily close back above $4,540, or until the DXY breaks down from its wedge. The exact event that invalidates the bearish lean is Friday's ISM services print. A sharp miss on the employment component, they could trigger a rapid dollar unwind and send gold ripping back through $4,540 within hours. But until then, the trend is your friend. Do you think gold breaks below $4,400 this week? Comment yes or no right now. I am tracking consensus in real time and I will call out the results in tomorrow's video. Most people skip this section. They hear the analysis, they nod their heads, and they close the tab. That is exactly where the money is made. Keep watching, because the next 3 setups are designed for different risk appetites, and every single one comes with exact numbers. No ambiguity. Strategy 1, the sniper, conservative. This is the high probability fade. We wait for price to rally back into the resistance that has been rejecting everything. The trigger is a 1-hour candle close inside the $4,535 to $4,540 zone, with a bearish engulfing or a long upper wick that is above the MA20 on the 4-hour and above yesterday's high. So if price gets there, the structure has shifted. Take profit 1 is set at $4,490, which is current price and a quick 1 to 2 risk reward. Take profit 2 is at $4,440, just above the first major support, giving you a 1 to 4.2 risk reward. This setup is voided if we get a 4-hour candle close above $4,560. The sniper, conservative, entry, 4,538, 1H bearish close confirmation, stop loss, 45.62 take profit 1, 44.90 take profit 2, 44.40 risk, reward, 1:4.2 hour invalidation, void if 4H close above 45.60 strategy 2, the active trader, standard. This is the momentum breakdown play. You do not wait for a pullback. You wait for confirmation that the floor is cracking. The entry condition is a 1-hour close below $4,485. That level represents a clean break of the overnight low and a structural lower low on the 60-minute time frame. The stop loss goes at $4,510, just above the MA5 and the intraday value area high. If price reclaims $4,510, the breakdown is false. Take profit 1 is $4,438. The first key support, for a 1 to 1.9 risk reward. Take profit 2 is $4,393. The high volume node, for a 1 to 3.7 risk reward. Once take profit 1 is hit, move your stop to break even and let the runner target the 200-day MA zone. Type your gold range for tomorrow in the comments now. Are you seeing $4,480 to $4,420, or a wider range? 43.93 risk, air reward, 1:3.7 hour invalidation, 1H close above 45.15 strategy 3, the aggressor, high risk. This is the counter-trend value play, and it is only for those who can lose small and manage risk aggressively. The idea rests on that analyst note. Gold under $4,400 still offers strategic value. We set a buy limit order at $4,393, right inside the support zone above the 200-day MA. The stop loss is at $4,379, which is a clean break below the 200-day MA at $4,384. That is a $14 stop, so position size accordingly. Take profit 1 is $4,490 for a rapid 1 to 7 risk reward if the bounce materializes. Take profit 2 is $4,540, the ultimate recovery target. This is a low probability, high reward play. If the daily candle closes below $4,384, this setup is dead and you must cut it immediately. Do not marry this trade. It is a sniper's counterpunch, not an investment. The aggressor, high risk, entry, 4,393, buy limit, stop loss, 43.79 take profit 1, 44.90 take profit 2, 45.40 risk, reward, 1:7 hour invalidation, daily close below 43.84 never risk more than 1 to 2% per trade. No positions through high impact news, period. I do not care how confident the setup looks. If ISM Services is printing in 10 minutes, you are flat. Stops are non-negotiable. The difference between a trader who survives 20 years and one who blows up trades below that number on a 4-hour close. The bear flag activates and the decline accelerates toward $4,393 and $4,339. If it holds, we chop and potentially build a base for the bounce. Tomorrow's focus is the US ISM Services report. That number is a wildcard that could completely reverse the dollar strength or supercharge it. I will be live with the breakdown the moment it hits. If you want the full cross-asset picture, including Bitcoin's divergence from the S&P and the crude oil supply shock, that video is live on the channel right now. Tap the end screen. Smash the like button if this gave you a clear, actionable plan. Subscribe, hit the bell, and type 1.